Welcome everyone to episode number 23 of the Wide Lens podcast. I'm joined here with my colleague Matt Rigby, and we're going to cover the latest topics in financial and investing markets. We are recording this not on Friday, but on Monday, the 4th of July 2022. We'll get straight into Matt's Market Minute.
The Jordan episode, number 23. Happy birthday to my brother, by the way, 4th of July. And happy Independence Day to all the Americans out there.
It's all happening. Matt's got us updated. Thank you.
Okay.
Thank you, Google.
So last week, the ASX 300 down 0.6 for the week, down 14.2 year to date, and financial year down just under 10%, 9.87. Notable news out last week, Link Market Services. So they are, I think I mentioned a couple of weeks ago, they are under takeover offer by Dye and Durham. So they're up about 1.5% last week. So they've come out, the Canadian company come out and reduced their offer price to $4.30 down from $5.50. And I think from memory, they're still trading below that $4.30 mark. So the market was up on that, probably just on that the company's still interested in taking out Link. BWX, the healthcare skin company, they're down about 16%, down to 68 cents, following a pretty deeply discounted capital raise. They raised about $23 million to pay off debt at 60 cents prior to the capital raise. They were trading so 49% higher than the 60. So what's that, about 90 cents? So yeah, pretty deeply discounted. Obviously worried about cash flow and debt there, interest rates, and some upcoming debt maturing. I think also they're close to breaching some debt covenants. So that was interesting. We might see a bit more of that coming up. Star City announced a new CEO, taking Rob Cook, who was the CEO of Tyro Payments. So Star City's up about 3, Tyro down about 27.5. I think I mentioned, was it last week, that one of the CEOs in the US announced their retirement, or that they were leaving and the shares were up? So this is the opposite.
Zoom.
No, it was DocuSign or something like that, I think.
Oh, yeah. That's right, yeah.
So clearly the market likes Rob, because the From company down significantly. Anyway, so he's now the CEO of Star. He's got quite a big mountain to climb ahead of him with all of their recent troubles. And Metcash up about 2%, announcing better than expected 2022 earnings, expecting sales growth of pretty decent numbers over the next year or two, and also announced a pretty big dividend increase. The Nasdaq 100 down about 4.7 for the week, down 29.79% year to date. They're down about 21% for the financial year. Around 77 stocks down more than 10%, 14 in positive territory. The S&P 500 down around 2.5 for the week, down 20, smidgen over 20% for the year. And for the financial year, they were down around 12%. Bed Bath & Beyond missed earnings, down about 30%. And CEO Mark Tritton has announced he's leaving. Now, he came from Target, was talked up as someone that could really turn them around. And I think he started to, but COVID really kind of smacked them across the back of their head and haven't really recovered. Tesla down about...
Wouldn't COVID have helped them with like interior upgrades and purchases?
Yeah. Well, I don't know what their online presence is. I think they were just starting to build that out or have a better online presence.
No, their COVID, the Bed Bath & Beyond, their share price went from $5 pre-COVID. It hit $35.33 1 year after. In fact, less than 1 year in. And then they've just been clobbered ever since.
Yeah, and I don't know when Tritton came in. I think he came in...
4th of November 2019.
Oh, there you go. I was going to say late 19. Yeah, so they did recover, you're right, but gosh, they're now below their...
Yeah, they are.
Or they're at about their COVID low.
No, they're below their COVID low, $4.71. Yep.
Yeah, right. So, been hit hard there. Tesla fell last week. Who knows why? The newspapers or the media would have us believe that it's because investors finally realized that the Shanghai plant had been shut for most of the last quarter and that the production numbers were going to be down. I think everyone
we just realized that, did we?
Yeah, well, this is according to the media. I think everyone probably knew that was going to be the issue. Tesla actually came out Friday night after market close with their production numbers. They were pretty decent, like 255 odd thousand in cars produced, similar numbers sold. But I think they've announced or they're expecting about a 40 to 50% increase in the current quarter.
Does that surprise you?
Not at all. Because I think they came out and also said that June was the highest production month they'd ever had. So that's the Austin plant is now producing it at 5,000 a week. The Berlin plant is now 1,000 a week. Shanghai is back up and running. And you've got the California plant humming along as well. So the next quarter should be interesting to see how the market reacts to that. FedEx down about 10%, came out, had their investor meeting during the week. Looking for earnings per share growth over the next 3 years of between 14 and 19% each year for the next 3 years. So that's pretty impressive numbers for a company of that size. They also said they're going to keep their price at or above inflation. So some price rises coming through there. And Zendesk being taken private at 77.5 a share, which is interesting. There's been a bit of a trend of these kind of tech companies being taken private. So that's another one in what may well be a long line with private equity still pretty cashed up, public market valuations coming down. So we'll see what happens. Emerging markets down about 1% last week, 13.5% for the year to date, 15%, down 15% for the financial year. Oil down about 1%. Bit over 1% for the week, up 40% year to date, and sitting about $105. Thanks for the coffee, Carlos. Sitting about $105 a barrel. And Bitcoin down about 5% for the week, down 59% for the year, $19,272 a barrel. They got down low 18s.
Do you know what's shitting me? All these people coming out from the woodwork, coming out from under the covers, these gold bugs, going, I told you so. And LinkedIn is flooded with these after-the-fact geniuses.
Oh, really?
Oh, mate, it's all it's everywhere.
What is it about human nature that just likes to kick something when it's down?
They're dancing on the grave of Bitcoin.
Yeah. Look, I have no doubt it'll come back. What's the price it gets to? Nobody knows on the downside, and what it bounces to.
Really shitty. Guys, pull your head in. Stop making stupid comments on LinkedIn. we all know you're a genius. I'm curious how short you were on Bitcoin, given the conviction that you had. But look, let me bring this chart up. Now, this was Morgan Stanley, and it was from Morgan Stanley Research, actually, that I came across it. Now, what this is showing is Bitcoin's market capitalization trajectory, and MS is saying it's all about the money supply growth, a la Fed policy. This was really interesting for me, and I just want to tell a quick story about this in a second. But you can see global M2 money supply year-on-year change in blue. You can see the Bitcoin market cap year-on-year percentage change in the right-hand side, and that's in the gold. Now, as you can see, as money supply starts to expand, you see Bitcoin market capitalization really start to inflate. You see that through the teens, 16, 17, 18, and then again during COVID as well. And we saw expansion in Bitcoin's market cap. Now, if you look at this really, what was Bitcoin predicated on? What was Bitcoin's hang on kind of thing? What was it? Let's go back to basics. What was it about?
A new form of exchange.
Why?
Excuse me, that can't be easily expanded. Excuse me, by governments, right?
But
so
why?
Can't print money.
Yes,
was the central
Correct.
premise, yeah?
Correct. And further to that, it was all about money printing is going to be inflationary. I mean, who would have thought that inflation would come out the way that it did? I don't think anybody predicted that. But I think the point of cryptocurrency also is that this fiat money is going to go to nothing.
Yeah.
And so we need
Something
a decentralized currency, digital currency, that will allow as a means of exchange and will not be influenced by or manipulated by central banks.
Yep.
Can I just make a massive shout out here? Big apology to Pomp. Last week, we were ridiculing Pomp, laughing in his face. Everything he spoke about makes complete sense. Now, I'm just going to bring... give me 1 sec. I don't have it here, but I want to reread to you. Was that episode 22, Matt?
It was last week. 22.
Episode 22. Let me reread this. How many people are now yelling, why is Bitcoin going down but inflation is high? Inflation hedged fail, ha ha ha. Wrong. Bitcoin and other assets are crashing in anticipation of inflation coming down. Investors understand what the Fed is doing. They are moving in advance of the results. Just think this through. The central bank is contracting money supply.
Yep.
Right? Mm-hmm. And so this printing of money.
Yeah.
M2 money supply, is this going down or down?
Down.
Dramatically.
Yep.
And so to me, this looks about right. And what Pomp was talking about and what we were laughing at last week is in fact wrong. I've changed my tune on that.
You reckon?
Yeah.
So you think Bitcoin is going down purely because money supply is money supply is still increasing.
Sure.
But just at a near zero rate or near 1% rate.
It's the change. If we go back to the premise of the Bitcoin or cryptocurrency is there as a decentralized means of exchange because central banks around the world are printing so much money that this is going to become, like Zimbabwe, whereby you've got $1 billion notes, right?
Take your bucket of money to the supermarket to get
As that was being printed, you've got valuations and people just pumping up crypto. Now the opposite's happening. And so to me, that makes complete sense.
I know.
What do you think about that?
I'm not sold. I think most people are selling Bitcoin. And I guess maybe the question is, maybe you got to distinguish the average punter that's gone in and bought Bitcoin, they're panic selling because it's dropping. But they may...
No.
But hang on, they may influence the price by, 5% of all movement. Whereas the big institutional money that's gone in, which accounts for, say, 70% of price movement, maybe they're selling because money supply is falling, and then the remainder is...
No, I reckon institutions are selling because it's not the thing anymore. JP Morgan were laughing in the face of Bitcoin as an allocation to portfolios. And then another division of JP Morgan says, we're putting 1% of our JP Morgan tactical fund into Bitcoin. And so I reckon they're the ones getting in and out. We shared a chart last week which showed the number of registered addresses holding Bitcoin has been on the rise.
Yeah, that's right. Yeah, that's true.
Unlike inflation,
jury's out,
or similar to inflation, no one knows what's going on.
No.
So I thought that was really interesting. I'm understanding this more, and this makes sense to me. But clearly, I'm not as smart as these folk on LinkedIn about how stupid and how baseless this asset class is. All right, let's jump into the first topic here while we're at it on inflation. Now, we know nothing about inflation as we know nothing about Bitcoin, Matthew. Everyone is blaming the Fed and the RBA and other central banks for not being able to tame inflation. I want to share this exchange between Senator Elizabeth Warren and Jerome Powell, which basically sums up the key conundrum of the moment. This is a tweet. Senator Warren gets the first question, and she points the Fed's limits in addressing supply challenges. Warren, will rate hikes bring down gas prices? Powell, I would not think so, no. Warren, will rate hikes bring down food prices? Powell, I wouldn't say so, no. And so we're getting no by the Fed chair in response to these questions about inflation, and the Fed is being asked to tame inflation with its extraordinarily blunt instrument. Everyone wants the Fed and central banks to fix the problem. And when's our June CPI reading? Is it later this month?
Later this month or early next month.
Early August?
Takes a while to come out.
Yeah.
In Australia or the US?
US.
It'll be a week or two.
Okay.
It's usually fairly quick.
So the Fed's got this blunt tool. Jerome Powell saying, no, I don't think any of these things are going to help bring inflation down. Joe Biden sent a tweet. I don't know if you saw. He basically said, all of you gas station providers, bring your prices down immediately. Literally, it was...
Good on him. Like, far out.
Are you joking?
No. Saying 100%.
What's the president tweeting saying, bring down your prices?
What else
Is that actually going to do anything?
No.
Absolute joke.
Just focus pressure on it. Anyway, I'll let you keep going.
We've got wars, we've got a whole range of things going on, and I just don't know if simply raising rates are going to be the thing that pull prices down.
No.
It's like saying, by increasing interest rates, we're going to bring down the price of iceberg lettuce in Australia because there was floods in Queensland. Like the two are completely independent of each other. And we've just got this unfortunate sequence of events that have just occurred over the course of the last two years that has led to us to where we are today.
So do you think they shouldn't be raising rates at all?
No, I'm not saying they shouldn't be raising rates. I just don't know how direct of a line the interest rate rises are going to have on petrol prices. I mean, that one thing is the thing that I feel like is going to be the last thing that people spend money on. Last thing they cut spending money on.
Yeah.
Diesels are $2.48 now.
I know. Holy cow. It's gone up 15% over the weekend, over the last few days.
I've got no idea what's going on there.
And yet oil hasn't moved from the week or 2 weeks before. I mean, it's basically the same.
He goes on to say, there was an article in Bloomberg as well, which I won't bring up, but it goes on to say, what we don't know is whether we'll be going back to something that looks more like a little bit like we had before. We suspect it'll be kind of a blend, Powell said. We're learning to deal with it. Which is really interesting because I'm wondering whether they're going to be as aggressive to try and bring it down, or they're realizing how stubborn this thing is, and in fact, us trying to use this tool is going to be not as effective as we thought it was going to be. And this was very profound by Jay Powell. I think we understand better how little we understand about inflation. I mean, can we not just agree that and admit that we just have a booming economy?
Yeah, we do. And I've wondered a few times whether we get past this, and I don't know how long it takes to get past this kind of supply-led inflation spike. Yeah, so lack of supply coming out of Russia, lack of supply of goods and services, or goods coming out of China because of lockdowns. Once we get past all that, do we go back to 2019 where everything's pretty slow in terms of inflation comes right back down, and we kind of go to this low growth, low inflation, low interest rate environment? I don't know. Once we remove all this money printing and all that, I don't know what's changed since 2019. We've had this big spike in money printing and low interest rates, like exceptionally low interest rates. So once we get over that hump, I don't know that the fundamental causes of 2019 have altered all that much. I kind of, with, who was it? Gareth from CBA a couple of weeks ago. Rates will go up and rates will come down. late next year. I reckon the more I look at it, the more I think he's on the money.
There are more and more banks coming out with that point of view, with
Yeah.
rates going to be cut. In fact, now there are commentators and observers coming out saying that the Fed won't be able to raise
It's Monday morning.
Far out.
Jeez, man.
raise rates as much as they had originally anticipated.
Yeah.
So do you remember we're having 12 rate hikes and interest rates were going to 15% or whatever they were?
I think they're right. I just think, and I guess that interaction between Warren and Powell is, it doesn't matter what they do with rates, it's not going to affect oil. I mean, if you want oil prices to come down, remove the sanctions from Iran, get them pumping oil back into the economy or into the global marketplace. That brings oil down. Remove the sanctions from Russia, not advocating for that, but that brings oil down. That's how that's a hell of a lot more effective than raising interest rates in America or Australia or the UK. And oil is so important because it flows into so many, inflationary things, i.e., food, transport for food, and
100%.
So, that's a hell of a lot more effective than raising rates.
Yeah, the high prices. If people can afford to pay $2.50 in their car for diesel,
Jeez, yeah,
and
man.
another, let's increase interest rates by 50 bips. I'm not sure how much of an impact that's going to have in real life. To be honest, I reckon people are still going to fill up $2.50 in the diesel tank.
It's going to cut spending and it's going to cost jobs.
But it's not going to cut
and it's
spending.
not going to cut spending at
where you
pump.
want it to.
Yeah,
Correct.
I mean, your home loan is the last thing you don't pay. Utilities are probably right before that. Petrol's probably in that bucket.
Correct.
And then it's all
Discretionary.
your discretionary spending. You're going out eating at bars and wherever else. So that's what gets cut first.
Correct.
And that's a massive employment area.
That's right. They say the cure for high prices is high prices.
Cure for high prices. Yeah, that's right.
And-
Because you cut spending and prices have to come down to stimulate demand. Economics 101.
So I thought it was very profound that the chairs come out saying how little we understand inflation. Again, especially on LinkedIn, there are experts who have come out saying, well, how can the chair say that we now understand how little we understand inflation? That's your job. How can you not understand inflation? There are a lot of experts now on social media that are experts in cryptocurrency and Bitcoin, and also the makeup and how inflation works and how they control inflation behind
Who's
their
next?
keyboard.
He's just lining them up today. All right. No, I agree. Everyone's an expert in hindsight, right? Okay,
What do you
let's move on. So no one wants to come to Australia.
No one wants to come to
live.
Australia, or we're not letting anyone in?
No, I just made that up. So I'll pull up this article from the Financial Review. You might get the headline, but we'll bring up this chart as well. So net overseas migration year ending quarterly per
That's a cliff.
100,000.
That's a migration cliff.
That's a massive cliff, right? So essentially what's happened is we had pretty strong, robust net migration pre-COVID, and obviously it fell off because of travel restrictions, et cetera, but it just hasn't bounced back. And one of the key reasons seems to be the concerns about the way Australia, in particular Victoria, handled lockdown and the extreme measures. I'll say extreme. We weren't locking people in buildings, but pretty close. The extreme measures we went to keep people safe. I'm going to try to stay politically neutral here, but I don't think you could argue with it having long-term ramifications on people going, all right, I could move to Canada, I could move to the US, I could move to Australia, the UK. We're still in a COVID environment. What are of all of those jurisdictions, where do I feel the least confident about getting through without further restrictions? I mean, Australia's probably up there. The US would be the other end, I would think. Anyway, so there's obviously been some impact there. So the article, I'll pull out a few points here. So Australia's still suffering from a full year of international travel restrictions, so we haven't had all of the restrictions removed yet. So net overseas migration, which accounts for people who have arrived in or departed from Australia for longer than 12 months, so that's interesting or important because we haven't had a full 12 months yet, was a net outflow of 88,800 people for 2020-2021 financial year. That was the largest number of people leaving Australia since World War One.
Wow,
That's crazy, isn't
leaving
it?
Australia.
Yeah. Net
And even on
outflow.
that red line, you've got departures at levels not seen
Right.
until the early 2000s.
Well, and probably well before that, because the chart only goes back to 2000. So who knows what it looked like prior to that? And you would imagine it wasn't this low. At this point right now, I was looking at the low point. I mean, look at that 2020 low point.
Yeah, crazy.
That's crazy numbers. So Australia's long-term arrivals have almost reached net zero again in the past quarter. So that's good, relatively good. But net overseas migration is not expected to reach pre-pandemic levels for at least another 12 to 18 months.
Wow, it's a long road to recovery, isn't it?
Massively long, yeah. Just one other point here. So since March, more than 58,000 applications for skill visas, including permanent and temporary school places, have been lodged with the department. So that'd be the Department of Migration, I guess. Nearly 25% of those applications have already been finalised. So there are people that want to come here, probably not enough to get us back to where we were at this point. But certainly there are some people that want to come here, but we're just not processing them fast enough. But, so you would think...
Is that because they're working from home?
I don't know, mate. But you would think as a new government, that would be an area that you would prioritise, right? Like, just get these people in here, get them spending, get them... I mean, we've got massive employment, lack of employment
100%.
issues, right?
Do you think
So get these people in
Do you
here.
think this impacts Australia's employment situation, especially in hospitality?
100% it does. Yeah. I mean, look, I don't want to generalise, but generally, I'm going to get people in bars and cafes and restaurants, I would imagine are more likely to be tourists on tourist visas, backpacker holidays, whatever it happens to be, than people that have been living here for the last 10 or 15 years ago. Oh, yeah, actually, I think I'll do that now. I think that's less likely. So it's having a massive impact.
My joke working from home was that the people stamping the approvals are working from home.
Yeah, no, I got that. No. Anyway,
We were talking to a client of ours who was telling us in their area, in building approvals,
yes,
they've got...
that's right. Yes.
They've got the person that approves development in this particular area in Victoria works 1 day a week from home.
Oh, was he'd come back from retirement. Was that guy? Was that the same
Yeah.
person?
Yeah.
Yeah. So he'd retired. They didn't have anyone in the approval department, so they got him back for 1 day.
1 day a week working from
Far out,
home.
man. That's crazy.
All right. Anything else with that one? I think that's a huge one, Matt. I reckon the government does need to really... Migration always has been the biggest factor for the growth of this country.
Yep.
And until we can get that back to where it was, I reckon we're going to be pretty...
Yeah, and they're massive supporter of house prices. I mean, it doesn't take a genius to work that out, which, as we've said so many times, flows on to so many different areas of the economy. You get people in, ease some of these kind of staff shortages, so that helps the economy.
Small businesses.
Small business.
Yep.
I mean, it needs to come back pretty quick, you would think.
All right. Next topic I've got here, just keeping in tune with my critiques of observers.
Look out.
that are coming out of the woodwork. Bloomberg had this article, and I'll get this up now. The S&P 500 may have another 24% to fall. 150 years of market history shows this. This Societe Generale study that looked at post-crises market valuations going back to the 1870s. And so in the article, they go on to say the S&P 500 index may have another 24% to fall by year end if the past 150 years of financial market history are any guide. That's according to Societe Generale's, which calculates the benchmark gauge may need to tumble. Listen to these words. As much as 40% from its January peak in the next 6 months to hit bottom. That number comes at 2,900. Excuse me, the upper end of the range the firm gave is for the index to slump by roughly 34% from its top to 3,150. Let me bring this chart up now. This is from Societe Generale, and it looks at cumulative returns around bear market bottoms from 1870 to 2022. Now, zero in the middle of that chart there is the bear market bottom, and any
COVID
negative
low, right?
No. So the scale across the bottom is number of months from the bear market bottom. So the bear market bottom at zero is the bear market bottom, and then minus 30, 37 months, 34 months, 31 months. So you're getting closer to the bear market bottom, right? And then you've got post bear market bottom on the right hand side of that chart there. The red line is the pandemic, which is, you can see the green arrow turning, and you can see the green dotted line, which is the forecast. Well, look, it's not even a forecast; it's just a question mark they've got there in the legend.
They do too.
The brown line is severe bear markets. The grey line is all bear markets. You can see the lower bound and the upper bound. Okay, so you've got all bear markets, severe bear markets, upper bound, lower bound. Basically, it's one standard deviation, plus and minus. Now, what they're saying here is that if history is anything to go by, then expect that red line to fall down to that brown khaki severe bear markets line. Now, I don't know, and I studied statistics academically and math and anything numbers related. That doesn't have to happen.
No.
And so in and amongst all of the severe bear markets and all of the bear markets, etc., there are a wide and diverse range of outcomes that can look like this.
Yep.
Why the red line has to go anywhere near that green line is beyond me. Sure, it can. It can cross that line. It can go even further. We could fall 80%.
Yep.
Now, I don't know if I don't think we can use history as a guide to tell us how far that still has to fall. For all we know, we could have hit the bottom. We get GDP numbers in the end of July, in 3 weeks' time, for Q2.
Yep.
Now, I don't know the quarter's over, whether we're in a recession or not. No one knows until the numbers come out at the end of the month. My guess is we're not in a recession. And so if that happens and we're seeing the impact of rising rates already on commodity prices, what's going on in commodity prices around the world, which we'll talk about shortly, property prices, the stock market, whether central banks have to continue to raise rates as much as they are now. They may not need to do any of those things, in which case maybe we've hit a bottom. Maybe the market's just plateauing out, waiting for some sort of affirmation before it continues to rally on from here. So that's the first thing I wanted to just bring up. I saw that last week. The other one is, I'll bring this chart up. We put this chart together, which looked at consumer sentiment versus positioning. The red line is consumer sentiment, which is at an absolute all-time low. We haven't seen this level of poor, weak, whatever you want to call it, negative consumer sentiment for decades.
Yeah, God.
What we've then done is we've overlaid the green line with the red line with a green line, which is the investor allocation to equities. Typically, the sentiment and allocation to equities mirror each other. The issue we have here at the moment is that the allocation to equities is not reflecting what consumers are telling us. And so we've talked about on numerous occasions whereby consumers are telling us one thing, yet the numbers that are coming out they're coming out with something else.
Yep.
And so we can be reading all of these pessimistic headlines and these surveys. The reality is that investors continue to maintain a relatively high degree of allocation to stocks or equities in their portfolio. In fact, 68% of portfolios are still allocated to equities. Next chart I want to bring up, this is from JP Morgan. I don't know if you've seen this one, Matt. Signs of capitulation. Stocks trading underwater. Percentage of companies trading below cash and short-term investment value. And it's getting north of 12%, which is well and truly beyond that of the tech wreck, well and truly beyond that of the GFC, COVID. And so going, again, further highlighting what is going on in the market at the moment, companies are trading for less than their cash or short-term cash equivalent valuations on their balance sheets, which to me is pricing in a pretty pessimistic, pretty pessimistic outlook.
That's crazy. I hadn't seen this chart, and it's significantly above. I mean,
look
really,
at COVID.
Yeah, COVID barely even rates a mention in there.
Correct.
GFC. Yeah, and I feel like that's. I mean, it's a line. I feel like that's going higher. I don't know why, but I just feel like
recency bias.
Probably.
The next article, and I'll bring this one up. This is from the ABC. A client shared this with me, and I got a bit frustrated. Not at the client, but at what is being published in the media at the moment. Shares, property, bonds, cryptocurrencies face major falls. Australian Office of Financial Management CEO warns. Excuse me, jeez. In a speech to economists this week, he warned asset markets could experience significant falls. Mr. Nichols says, how far it goes and for how long it continues is difficult to forecast. But what is likely is that it will continue to be associated with strong bouts of market volatility. There's nothing profound there, to be honest.
Pretty broad statements.
But where was this guy 6 months ago? They're coming out now predicting significant falls to asset prices. Well, no shit, stocks are down 60 to 70%. The NASDAQ is down 35%. The S&P 500 was down 25%. How much more significant? Like, why are you telling us this information now?
You have a rough weekend.
Man. Do you know why it's frustrating? Because investors read this. Clients read these documents, these articles, and they are by reputable people who are coming out now 6 months into a bear market, making these...
Calling the market's going to fall.
No shit. The market's fallen.
Yep. Yeah.
And going on to talking about, well, yes, we're going to see strong bouts of market volatility. People hear that. People don't want to hear there's going to be market volatility. But market volatility is what the market does. This is the cost of admission, as you say, Matthew.
Yeah, absolutely.
And so in order for you to get the 15, 20, 30% upsides, in order for you to get the average 10% per annum increase in your stock value, is because you have to go through periods of downturn.
Yep, you take on risk.
And it's frustrating. It's certainly for us, because we're here defending a war that's going on over there that we're not even involved in. We're trying to shift the conversation this way and look ahead and use data to help us make those decisions. Then you've got people coming out making wild claims about stocks and cryptocurrency going to fall further. Cryptocurrency is down 80%. Like, how much more are they going to go down? I'm not saying they're not going to go down anymore. All I'm saying is we've gone through that.
Yep.
Thank you for highlighting the Captain Obvious.
Yeah. With all, I know you've got a little bit to go, but with all of this, I kind of look at it and go, I just want to know, maybe I'd love it if the media said, all right, here's your prediction. That's fine. It is what it is. But what's your track record? Like, how accurate have you been in the past? Like, have you just been way off the mark and you're just coming out saying something to get some airtime?
That would be really...
How awesome would that be?
You know, that would be really valuable. If any if anyone is being quoted in the paper that he said, she said, there needs to be an asterisk with the player profile. And the player profile needs to have a batting average. How accurate or inaccurate has this person been
over the last 5 years, 10 years, 20?
Fine. And if you've got a history of less than 3 years, you're unrated, right?
That's it.
And you've got a player profile, and then people can then judge, how reliable is this information?
Exactly right. No, absolutely. And what were they saying during the last up? Like, were they saying markets are going to keep going up? You know, because I don't know. I mean, this guy might be a genius, might be a clown. Who knows? I don't know. But
everyone's talking a lot of shit right now.
That. And I'd also love to see, last time we heard from you, you said this, and here's what actually happened. It just drives me mental. It's like watching, research stock analysts come out and go, all right, the price is dropping. So there was a company I was chatting to a friend about, and he's like, oh, did you see they cut the price? I was like, yeah, I saw that. He goes, did you see why? I was like, no. He said, because the industry's down, so they cut the price. I'm like, well, it's completely irrelevant to the company. I mean, what they do. Anyway, just drives me bananas.
Just finally, which I think for whatever it's worth, this is Australian data. Retail sales up 10% for the year. Job vacancies up 30%. Business credit up 13%. Household deposits up $300 million to $1.3 trillion. What recession are we in right now? And look, I think right now, if you are not confused and if you are puzzled, if you are unsure as to what the hell is going on, I just don't think this is your typical sort of common bear market with what's going on. The markets are falling. Yep. We're in recession. We're not in recession. Rates are rising. I think admitting to some sort of disorientation is not a bad thing. I think it just shows that you are being honest and transparent and that you actually don't have any idea what's going on. Yeah. And I think that is very humbling.
Yeah, I mean, it's crazy. And, we're getting a few questions and friends are asking, like, what's going on? Are we going into recession? Like, I don't know. But if you're worried, then just
someone asked me, they said, oh, what is a recession? So I went on to explain to them what a recession actually meant. Yep. And they said, oh, is that what it is? So are we in one? And I'm like, well, I don't know.
And so I'll tell you in 6 months' time.
And this fear that the media is instilling into everybody, people don't even know what the hell it is.
No.
But they're so afraid of it because that's the light that's being shined on all of this.
Yep.
All right, rant over. Over to you, Matthew.
All right, gee. All right. Okay, so this... so I'll bring up this chart now from Jim Reed at Deutsche Bank, who, man, this guy publishes a lot of stuff. His research team are just on it. I think there must be either 1 million of them or they all work 24/7. But there's always a lot of information he's publishing and putting out there. And it's referenced a lot as well, which is interesting. So in terms of track records, he's got a lot of references.
5 stars.
He's happy to admit where they get things right or wrong. He's kind of willing to put their opinions out there. But anyway, so this chart's basically tracking US consumer sentiment versus the unemployment rate. And as you can see in here, that it's been a fairly tight correlation, going all the way back to 1952. So yeah, there's periods where it's kind of decoupled, if you like, but nothing like what we're seeing at the moment on the right-hand side. So you've got the unemployment rate in the light blue color, and you've got the index of consumer sentiment in the dark blue color. And, there's, as I said, periods of time where it lags, but the deviation at the moment is, you would say, at extreme levels, where you've got like we saw earlier, consumer sentiment is just fallen off a cliff.
Why has it fallen off a cliff?
Well, I'd say, to your point, your last comment about the media's kind of insistence on we're going into recession, interest rates are going up, inflation's out of control, we're going into recession, share market's falling, we're going into recession. I mean, this is as you said, you pick up any newspaper or if you pick up newspaper, log on to any news outlet account, and that's the message. That's what's going on, and that, I think that weighs. You see petrol prices at $2 whatever a litre. I'm like, shit. It used to cost me $60 to fill up. Now it costs me $100. Like, that's a fair difference. Your mortgage repayments have gone up and expected to keep going up, and consumer sentiment, I think, is more about forward looking than it is anything else. Like, it's your expectations of what is coming down the road. So if you take a a sentiment survey, you're factoring in right now, but I think you're also factoring what you expect down the road. And if all the news is negative, it's no surprise at all that consumer sentiment is down. Anyway, so a couple things that Jim mentions. So I'll just pick it up here. So the preliminary University of Michigan Consumer Sentiment Survey, printed 2 weeks ago, which was probably now 3 weeks ago, started a savagely volatile period for markets. So what he's saying is that when the survey came out and it continued to be down, share markets reacted negatively. So after long-term inflation expectations increased 0.3 to 3.3%, the highest since 2008. So when you see long-term inflation expectations, that the more that inflation gets embedded into people's expectations, the more they are likely to pull back on spending, cut big items like cars and furniture and whatever else, and obviously that has a pretty bit of a snowball effect.
Do they, or do they buy it now and say, well, I better buy it now before it goes up?
Well, I guess there's two. So if it's just purely inflation, you're probably going to bring that forward. But if you've got inflation with negative news also being kind of rammed down your throat, you're like, well,
sure, okay,
maybe I'll hold onto that car for another year or two rather than buy it now. And that's the fear, is that everyone knows that, well, not everyone, most people know that as inflation goes up, interest rates are likely to follow. And so central banks are always looking at long-term inflation expectations of consumers, because it's a bit of an indication of wage pressures coming down the line as well, which feeds into inflation, and whether people are going to start spending now or they're going to pull back, and it can go one way or the other. So they go on to say we haven't been above 3.4% in long-term inflation expectations since 1995. And so given this print at 3.3, that helps cement a 75 basis point Fed hike last month. So it's important the Fed look at it, and I think the media obviously pick up on this stuff as well. So the report also showed the lowest consumer sentiment reading in the 70-year history, as we mentioned, and it mentioned in the chart there. Eyeballing the chart, while sentiment is clearly more volatile than unemployment, the peaks in sentiment and lows in unemployment tend to broadly coincide. So, there's a couple of instances where they circled it. So that was where sentiment had notably led unemployment. Interestingly, they were all between the 1960s and 1970s when inflation had structurally picked up. So what he's saying here is that if that environment is similar to the current environment, i.e. the 60s and 70s where we had high inflation, consumer sentiment led the unemployment rate. So consumer sentiment dropped, unemployment followed. And if that similar sort of environment that we're in now, a higher structural inflationary environment, you could well see unemployment follow consumer sentiment, or employment follow consumer sentiment, with unemployment rising and therefore leading into recession.
I wonder if we can...
And it's all speculation, but you can only point to history, right? And pointing to history, not always accurate, but something's got to give. Sentiment has to bounce back significantly, and that might be that the Fed come out and say, all right, we're not going to raise rates now for the next 2 or 3 months. That would affect sentiment pretty quickly. Or the reduction in spending starts feeding into unemployment.
Well, it could. I just wonder how possible, and I reckon this is. I think this outcome is underrated. Is that sentiment is so low right now, and everyone is predicting a very dire economic situation this year, that actually doesn't eventuate. And so what happens then, because we're not seeing all of these other data points drop as significantly as we're seeing with sentiment. I mean, this is a big decoupling here with unemployment, the unemployment rate and sentiment. We saw equity exposure sentiment. We saw sentiment, retail sales. Again, people are saying it's really bad, yet we're printing record retail numbers where I feel like there's so many discrepancies going on at the moment that it's really noisy, and it wouldn't surprise me if the sentiment turns to reflect what's actually happening and what people are actually doing. Because right now, people are saying one thing in surveys, and after I hang up the phone with the survey with you, I'll go and buy my thing online and ship this thing from Amazon, or go out and fill up $150 in my tank. Like, people are just saying whatever and doing something else. It wouldn't surprise me if sentiment turns much quicker than the other way around. In other words, all the other factors falling to match consumer sentiment.
Yeah, I mean, sentiment's something that can change really, really quickly. But unemployment, I mean, it's a fairly big decision to go. We're going to sack a whole bunch of people. Well, a lot of tech companies and crypto exchange companies. Apparently,
but they're the companies that hired last year, at ridiculous pace.
And they are, I don't know, a smaller proportion. Retail companies are still hiring because the spending demand is still high. I suspect it'll be somewhere in the middle. I mean, consumer sentiment's going to bounce back is so low that it won't take a lot to change that, to have it tick up. Equally, unemployment is so low, or employment is so high, that it won't probably take a lot for that just to tick down a bit. So we're probably going to get a meeting in the middle somewhere of each of those.
Let's move on to director's cuts. What do you got for us?
All right, so what do we got here first? Tesla. I kind of covered this earlier.
Oh, we talked about that.
Yeah. So ramping up their factory in Shanghai, getting back to volumes, expecting to be back at full, if not already, then fairly soon. We can jump that. I already talked about it. I forgot I put that one in.
What's your next one? What do you got?
This one's a bit more interesting. So we'll bring up this chart here. This is West Coast rail delays. So dwell times for rail-bound containers from the LA Long Beach shipping port, I guess you call it. So they're rising again. So basically...
Oh, bloody hell.
I saw this and was like, fuck, again? So essentially what you got here is that the higher the red bar, the longer containers are sitting at the docks. So we've obviously got through 21, we've got shipping delays and all the rest of it. Came down fairly significantly towards the end of last year, early this year, and on the rise again. Now, from reading the article, there's a few reasons why this is the case.
Enlighten me.
So part of it is employment enterprise bargaining agreements. So a lot of the dock workers and truckies coming up to renew their enterprise bargaining agreement. So there's a feeling that they're slowing down or taking a little longer, or maybe not coming in on the weekend, just to add a little bit more pressure and add to their bargaining power, which was interesting, cynical, but interesting. The other was, part of it is the trucking companies, in addition to that, just they're so flat out shipping stuff all around the country that any slight increase in the number of containers sitting on the docks can't translate to an increase in the number of trucks shipping or driving stuff around. So you get this really quick build up of inventory sitting on the docks. So I just thought it was interesting. We've mentioned a couple of times that shipping delays have not been really talked about since China locked down in their current COVID wave. Maybe this is starting to creep in. And, also I'd love to know what it looked like in 2017, 18 and 19. Like, what's normal? So anyway, worth a read if you've got the time.
What else? These are your all ideas here.
Man. Yeah.
What else you got? PayPal, Netflix.
Oh, yeah. So we've spoken before about these growth companies getting slammed. So I think it's Russell came out in their value index. So Russell have a growth index and a value index in the US, and they've just moved Facebook, Netflix, and PayPal from being growth companies to value companies. Somewhat interesting. I don't know. They're one or the other, right? So they've got to fit somewhere.
Yeah.
I don't know what they're or how they gauge what's a value company, what's a growth company. I guess Netflix aren't making profits. I don't know how they fall into the value category. But anyway, so they're now value companies. So FANGs may have to be rewritten. Can't have F in there anymore. No longer a growth company. And this next one is just the US GDP numbers. So I've talked about this a couple of times. So in the US, they come out with GDP estimates, then they revise, and then they revise it again as they kind of go through all the data and get a bit more certain about how everything's going. So in their final revision, Q1 US GDP was revised down to negative 1.6% as an annualized number. And there's a chart here that just sort of shows you the real GDP percentage change from the preceding quarter. And you can see that we've dropped off into the negative. So December Q4 2021 was fairly decently positive, historically speaking, certainly going back to 18. Pretty strong, but whether the first quarter of this year was just a bit of a snapback from Q4 being a bring forward, Q1 this year just balancing it up, or whether that's a trend, we'll find out.
We'll have to wait until July
24th,
27th or something like that for us to work out whether we're in recession this year.
Yep. Just one other thing to note, the OECD has US 2022 growth at 2.5% for the year and 2023 at 1.2%. They've got global 2022 growth at 3% and 2.8% for 2023. The US and global 2023 sort of talks to my thoughts earlier is, once we get past this, are we going to go back into a 18, 19 type growth environment? Yeah, the OECD, I don't know what their track record is on predicting this stuff. My guess is not great.
No.
But I think the trend is the one to watch there.
A couple of things I picked up on. Russia defaulted on its foreign currency sovereign debt after after the grace had a grace period of a couple of months, I think, and so that expired. The thing is, I didn't find that anyone was really picking up or writing about that. It didn't really make any headlines.
No. Barely got a mention.
No, and do you remember when the Euro debt crisis?
God, that was.
Do you remember that?
Yeah.
Like every day you'd wake up and someone's defaulted and the world is just falling apart.
Yep.
Russia defaults and just nothing.
Nothing.
The other final thing before we wrap up into tips and recommendations, which less market related. R. Kelly sentenced to 30 years in prison. Did you see that?
I did see that. Yeah. Holy cow.
So he was sentenced to 30 years in prison in Brooklyn Federal Court on Wednesday after being convicted of racketeering and sex trafficking in September 2021.
Oh, really?
Yeah.
So I thought it was quite a while ago.
So he's been in jail since 2019 and he's facing separate charges of child pornography and obstruction of justice in a federal case in Chicago where a trial is set for August 1.
Wow.
In 1 month's time.
So R. Kelly, if you're listening, because you've got nothing else to do in jail, you've only got 27 years to go.
Man.
That's crazy. I mean, he was...
R. Kelly was like...
huge.
Massive.
Absolutely massive.
His songs...
I Believe I Can Fly,
Yep.
That was in... was that in the...
Space Jam.
Space Jam.
Yeah, with Michael Jordan.
Yeah.
Looney Tune characters.
Yep.
Tips and recommendations. What do you got for us today?
All right, I've got this is probably not really much of a... Well, it's a recommendation. It's a good recommendation. Anyway, so anyone who isn't aware of a little cycling race called the Tour de France.
No.
Have you heard of it?
Yes, Matthew, I've heard of it.
Mate, I love this thing. I just love... These guys are freaks. Their endurance is amazing. Every year I'm just stunned at just...
Is it on at the moment, is it?
It's on at the moment. Anyway, so kicked off on Saturday with the time trial. It's in Denmark at the moment. So the first 3 days, which finished last night, are in Denmark. Mm-hmm. And then it moves on across to France. Goes for 3 weeks. I'm sure you're all aware of it. Anyway, so just so there's 9 Aussie riders this year.
Wow.
So Ben O'Connor, he came 4th last year, won a stage, probably caught, I don't know, maybe caught some riders by surprise last year. I don't think he'll do that again this year, as in catch them by surprise. But he's, one to watch. He's a good, aggressive rider, good in the mountains. They're in the flats at the moment, so more for the sprinters.
They are machines, aren't they? Just the way they...
mental. It's mental. And what I love is they ride their ass off at 200 Ks, averaging, 40 Ks an hour or something. They get to the end, and then they jump on the warm-down bike, like just to pedal out another half hour, like far out. Caleb Ewan, so he's certainly one for the sprinters. I think he's sitting... I don't know. He picked up some points last night. Anyway, so he's one to watch on the sprint, the flat stages. There's a whole bunch of others. Michael Matthews is in there. He's always up there for, some sprinting, out in the breaks as well. Anyway, so if you haven't gotten into it, if you love strategy, if you love teamwork and kind of just, guys sacrificing themselves for the teammates, man, it's such a great event. So jump on, have a look.
That will motivate me to get the bike off the rack in the garage, but it's too cold.
What do you got, mate?
I bought a new bed. I don't know when the last time you bought a bed, but we had the mattress on the floor for a few days, and I told my point of view was that beds are like flowers in the florist industry on Valentine's Day. It's just a scam, just to get people to buy flowers.
Okay. And beds are a scam.
Beds are a scam. You do not need a bed. The mattress can sit on the floor. It is the hardest.
Oh, you mean you don't need the base?
You don't need a bed base.
Yeah, okay.
Yeah. You have a mattress on the floor.
Yep.
And so we had that for about a week, and it was so bloody good. Like,
really?
Obviously it's not moving, and just had such good restful sleep. The reason why I think there are bed frames, and I could be wrong on this, is that your doona covers and all your blankets and stuff are not high, are so long that they just droop on the floor, and so the bed frame boasts it up, and so your doona covers and your blankets
just looks all nice and
looks
neat.
nice and neat.
Nicely.
So it's a massive scam. You don't need bed frames. You don't need slates. Jeez. You don't need nothing. Just on the floor.
Mattress.
But anyway, we bought a bed because our doona covers are too big and they sit on the floor. Bought a koala bed. Have you seen them advertising?
Are these the rollout ones where you get them in a box?
No, they've got a koala. That's a mattress. Yes.
Oh, okay.
But we bought the bed frame, so they're all eco-friendly and whatever. In fact, this morning coming into town, I saw an advert on a tram saying, with the koala bed, and it had the bed in a forest, and it said built with the world in mind. Okay. I don't even know what it means, but it was pretty cool. But admittingly, it came within a week. You get a regular updated thing, so that shipping and tracking was on point.
Okay.
The style is absolutely minimalist, really, really easy to put together, and admittingly, the slats, or they're not slats, they're just like flat boards. I don't know what you've got under your bed mattress.
Don't know.
But man, it's as good as sleeping on the floor. So I paid $1,200 for the privilege.
To feel like you're sleeping where you were.
Yeah.
Yeah, right. Okay.
So
are they Aussie?
I don't know. Probably.
I don't know. UGG's not.
Yes, it was.
But it's not now. The UGG company.
Well, neither is... didn't Vegemite get sold? Or
Nah, they're owned by Bega.
What about RM Williams? Who bought that? Twiggy.
Yeah, that's right.
Yeah, they are.
Are they?
Made in Australia for Australia. How good's that?
Great job, Koala
Sydney manufacturer. Koala. Well, the name probably gives it away.
Yeah, but you just can't take anything.
So the beds are really nice. They're very minimalist. They're really progressive style. So if anyone is looking for a bed, the Koala's pretty good. They've got limited range. Everything's online. But we had our bed for years. Deb sold it on Marketplace.
What? Oh, the base.
The base, yeah.
Yeah, right.
Yeah.
Huh. Okay.
So koala beds, thanks for
Koala
that.
beds, look at that.
You're as good as the floor.
Getting a shout out. It's the highest compliment Rob has given today.
Bloody scam.
He's been on a tear.
Beds. Rant over for today. We'll be taking a break for the school holidays for the next couple of weeks. So we'll see you back here in a couple of weeks.
All right. Cheers,
Thanks.
guys. Bye.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.